So we move on to our next presentation. I would like to call upon Mr. Pratik Biswas, India Lead, EV and Battery Supply Chain, Policy Research, Wood Mackenzie. He would be speaking on topic Pathways to Electrify India's Transport Sector while Building Battery Supply Chain Resilience.
Yeah, thanks for having me here. I'm Prateek. I'm an analyst based in Wood Mackenzie, and my area of expertise is policies and OEM strategies that are impacting the transport sector, really. I work in a team called Electric Vehicle and Battery Supply Chain, EVBSC, and our remit is the entire EV value chain, really from downstream recycling till upstream mining. What we essentially do within this team is liaise with all the different teams within Woodmark, the commodity teams that are looking at the mining sectors of the different commodities that are going to the batteries, the charging infrastructure team, the teams that are looking at macroeconomics. And our job is to essentially create a very accurate demand forecast for battery demand, battery raw material demand, and vehicles till 2050. Now, today I'll be discussing our outlook for the Indian four-wheeler space specifically, not any other particular segments, which I'll be talking about passenger cars and commercial vehicles, the electrification potential, the critical mineral demand, what India can do to boost its electrification beyond the current trend that exists right now, and what it can do to achieve self-sufficiency when it comes to the building blocks of this new ecosystem that we are creating in this particular country. So starting off, I'll just give a brief context around the Indian electrification front, really, where it sits within the wider global market. And as you can see here, PEVs, or as we call it, plug-in electric vehicles specifically, they account for roughly 2% of the market in India at this point. It's far lower than anywhere else. And more importantly, the growth rate over the last 2 years is also extremely slow. It's increased by maybe 0.5%, while for China it's grown from 25 to 35%. For US it's grown from 6% to 9%. For Europe, it's grown by at least 1 or 2 percentage points till around 19%. So the core takeaway from this particular slide is that India has a very long way to go when it comes to both EV volumes and, more importantly, the penetration rate to begin with, really. Things get a bit more interesting when we consider our forecasts, really. Specifically for four-wheelers, by the way, just as a FYI. We are expecting the PV penetration for India to hit around 11% in 2030 and around 18% by 2035. So what we can see here is definitely that we are definitely not hitting the 30 by 30 target. And the low penetration, the relatively low penetration rate is really driven by the fact that we are expecting the four-wheeler market to grow massively. As you can see here, it's growing from 4 to 5 million to more than 12 million, 3 times the size by 2035 in the next 10 to 12 years. That's incredible considering the European market is stagnating at around 16, 17 million. US market is around the same volumes. China market, we're expecting it to grow slightly to from 22 to 27 million or so. And the focus regarding this are entirely driven by our understanding of the GDP penetration rates, that GDP forecast for the Indian market, urbanization, rising incomes, the regulations that are driving the scrapping of old vehicles with new vehicles, the growth in the road and infrastructure. All of these will essentially contribute to the large size of the market and essentially drive the PV penetration to be relatively lower than what you would normally expect in a slightly different market. Either ways, you will still expect, based on these current trends, which are relatively conservative in the industry at this point, for around 2.5 million PEVs. Most of these will be battery electric vehicles itself. And that's essentially the gist of this particular slide, really. That being said, electrification in the Indian market, even though it's still fairly strong in terms of volumes, it does need to pick up quite a bit if India needs to contribute to the global goal of 2050 net zero. Now, that's of course diverging away from the 2070 target that we already have, but I've plotted here essentially the our base case outlook for Indian vehicle electrification and vehicle electrification in India if the world move towards a 2050 net zero scenario. As you can see here, the delta in the volumes and the penetration rate is quite massive. So the question is really, what can India do to align itself with the global net zero 2050 scenario, really? Now, of course, we can add the existing drivers that already exist in the market for other countries. We can make the fuel consumption norms a little bit more strict. We can add subsidies as well. We can shift the balance between retail and fleet sales, specifically because fleet sales are easier to electrify, primarily because of the benefit in kind policies that can be implemented very easily in European and US markets. But at the end of the day, this carrot and stick approach is not a very long-term solution. What India needs is a very cohesive 10-year blueprint. It needs an industrial blueprint. It needs to subsidize the building blocks, the production of the supply chain, both in components and materials, to get the scenario to actually work out. Essentially what China has been doing over the last 20 years or so. All of these would be essentially going against current market economics, free market economics, but it's still required. It's very critical to achieve this. Whether it will be done is a question to be noticed. Of course, we will change our focus on the basis of that, but that's what it is. Now, the next part of my presentation is around supply chain resiliency. We've seen the same stats around how China dominates the supply chain really in terms of the battery raw materials and refining. But what I'll essentially go into is how does Indian supply in our base case forecast from the commodity teams fare against our base case demand really outlook. For that, I'll just touch upon the brief points regarding demand. As you can see here, we are expecting the battery demand for four-wheelers specifically to grow 50 times. That's quite a lot, actually. That's entirely because we're expecting electrification to grow within the larger vehicle segments as well. The electric range to increase as well. The CAM demand, the cathode material demand, and the raw material demand will grow proportionately as well. And it's not entirely proportional. There will be variations. The CAM demand will not grow as fast as battery demand entirely because of the improvements to energy density. The raw material demand, again, will depend on chemistries, which will get impacted by things like a shift towards nickel-rich chemistries or manganese-rich chemistries for particular segments within the Indian market itself, really. So how exactly does this Indian supply and demand scenario look like, really? We've seen news reports coming around mines within India that could supply EVs for 1 million EVs a year or something like that. ACC funding has been provided, PLI funding has been provided for battery projects. But if you take a look at our base case forecast, as you can see on the right side here, things are not looking particularly rosy. Self-sufficiency, if you take a threshold of around 20%, it's not exactly ideal. As you can see here, I think the only place where we can see a bit of self-sufficiency around 20% is graphite and battery anode projects, mostly because we have quite a few mines in Jharkhand. We have very high capabilities for synthetic graphite feedstock, specifically needle coke, thanks to our Indian steel mills. But apart from that, apart from anode materials, from graphite products and refined cobalt, is looking really bad. Now, why is this specifically? Mostly, it really depends on the product to product. For batteries, the fact is the matter is we are not really forecasting any base case production for 2035, irregardless of the fact that ACC has been provided. The entire reason is that, firstly, these projects, we don't foresee them being able to actually scale up. It's going to be very challenging in the current environment where Chinese cells are extremely low price. They are throttling the competition in the Indian market. They are going to throttle for a while. And more importantly, we don't have the technical expertise. For something like, for active material, for example, we just don't have the capabilities at this point, really. For something like lithium, as example, the 5.9 million tons of LC that we found in J&K. The fact of the matter is it's lithium clay. And nobody has yet found a perfect recipe for actually extracting it at a cost-efficient case, especially when you consider our forecast for lithium prices, which will remain relatively muted, mostly because of the minor surpluses we expect existing in the market. So all of these factors will essentially drive down the competitiveness of the Indian space at the end of the day, and this is not really a good picture. what can be essentially done to fix this? Now, the PLI schemes are, of course, very helpful. They might help, but what I essentially mentioned previously as well is we need a concerted investment approach beyond the ones that are existing right now. We need to move away from free market. If we consider the current LME prices, none of our projects are ever going to achieve scale, really. None of them are actually going to receive the funding to receive scale. What we need to do is de-link away from LME prices and link them specifically to national interests. All of these projects that you can see here, all of these need to be funded, but not based on the future profitability, but on the basis of the fact that if you do not have self-sufficiency, it's going to be a really bad picture if China suddenly decides to restrict exports for some reason. It's going to be a really problematic thing. A second way of looking at self-sufficiency or resiliency in a way is through international partnerships. It's not just getting materials from yourself, it's really. Now, the US has its own critical mineral-focused free trade agreements. The EU has strategic partnerships. It essentially signs with different countries. India has its Kabul state-owned firm designed to invest overseas. But what we essentially have is a far greater tool is the Mineral Security Partnership. The Mineral Security Partnership is currently focused primarily around information sharing. There will be a degree of investment sharing as well at some point. But at the end of the day, this is a very cohesive partnership aimed by the US to create a coalition of countries that will de-link their supply chains away from China, create their self-sufficiency. Thankfully, India is a part of it. And if we take a look at the supply-demand scenario that I plotted for 2035 based on our base case forecast, things are looking relatively better as compared to the previous picture where the threshold was far lower, but the outputs were also far lower as well. I've plotted out the demand versus internal supply situation, and because of the abundant reserves of raw materials in these particular countries, the raw materials part is still fairly high. Nickel is a bit of a problem, of course, mostly because all of the nickel is currently being produced in Indonesia, and until Indonesia starts to become a part of the MSP or there's additional funding in Philippines, the nickel might be a bit of a problem. The other problem that we can foresee here, the deficiencies, as you can see here, are the midstream part, really, the components, battery anode material, and the cathode material specifically for LFP chemistries. Now, the interesting part is this is exactly where India can shine. For battery anode material, of course, I've already mentioned before, we have the feedstocks. We have the graphite, we have the synthetic graphite material from Indian mills. We have companies like Epsilon who are aggressively scaling up the anode material production, really. And for iron-based chemistries, even though there are certain companies who are looking at producing CAM, what we don't have are those projects yet, but what we do have are the feedstocks required for it. India is a fairly abundant source of iron sulfate for phosphoric acid. Both of these are critically required for LFP production. Now, there's an overcapacity when it comes to LFP CAM in China, and that has disincentivized the production and production of these materials into CAM or conversion of these materials into CAM. But that's the entire point of this particular slide, really, that India needs to de-link away from the overcapacity situation that's happening elsewhere and invest in these particular resources, get the threshold, use these particular strengths to establish a position within the MSP, and use those to leverage the import of other materials that we don't really have within our country, really. So that's the gist of my presentation, really, that these international collaborations can work in India's favor, but only if we actually invest, regardless of capacity, regardless of current market drivers, regardless of current market prices that exist in the outer market, really. We need to think very close to what China essentially does. We need to think of national interest. We need to think of establishing a supply chain designed for national interest, really. And with that, I'll finish off my presentation. Thank you for listening, and happy to answer any other questions later on regarding what all analysis we can essentially provide regarding this Indian market as well as the global electrification market itself. So thank you.